Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Tellurian. I have an updated DCF valuation model. This one's a little rougher than some of the other ones. This is sort of in response to a question I got on the Tellurian Discord, where someone had put together a spreadsheet. I haven't actually got access to the spreadsheet. I was gonna sort of kind of go through this. I DM'd him, haven't gotten it yet, but I just decided to go ahead and build my own that I think is kind of maybe similar. But really it's also trying to incorporate some of the recent things that some of the recent things we've heard around selling some gas at Henry Hub link prices, and just a little bit more of the detail that we've gotten recently, kind of putting this in a model and seeing how the numbers come out. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Tellurian, so this video should be for your entertainment purposes only. Because I could be wrong about everything I say in this video, you need to do your own research before making any investment decisions. And I think I forgot to put it in the description live, but I'll probably have it, pretty soon. I will edit in and put a link to this spreadsheet if you want to take a look at it, um, and play around with the numbers yourself. You can make a copy and do that. But like I say, someone in the Tellurian Discord had actually put together a spreadsheet that had something to do with, let me look at future dividends or potential dividends and discount it back. And kind of came up with some numbers. I have done a couple of similar models in the past, but I wanted to put together another one here. Like I say, I haven't actually gotten access to this, so I just made my own and want to go through that. But real quick, some of the assumptions this has baked into it, I didn't document them all in the spreadsheet, so I'll walk through it real quick right now. This is assuming this general uh, financing, and I actually don't go into too much detail with the phase one financing in the spreadsheet. Kind of take this just at face value and assume that it all happens. The most important pieces that I take away from this are a couple things. Oh, somebody's in the chat. Vladimir says this stock is a piece of crap, dilution like crazy. Yeah, I mean, as of right now, they are diluting, that's for sure. I think there's a lot of risk, which maybe I should pause here and maybe I don't emphasize this enough. There's a lot of risk in this company. Right now I think I don't have the numbers off the top of my head. I'd have to go back and look at Q2, but I mean they're either barely at break even, or they're losing money, and they're in just the sort of the overhead of the company and the gas upstream production, and then once you factor in the costs that they're dumping into driftwood, like they're burning through cash like crazy, and they want to continue doing that. They want to continue construction on driftwood, which at the current moment when you don't have the money is going to require some dilution, and then they even had to refinance their debt to push it out. Let's see. Vladimir says, I traded this thing enough and kept a small piece at no cost basis, 100 shares only, and sold some covered calls to lower my cost basis to less than zero. Yeah, I mean, there's, I don't blame anybody who's got out of the stock. I mean, I'll be honest and say right now, I'm holding paper losses. I still think there's potential. I personally, as I said originally, I'm still long Tellurian. I think there is still the potential. It's high risk, it's high reward. It's also not my entire portfolio. So, I have it for myself sized appropriately, such that there's upside if it does happen. And then if not, if this ambles along as a, low cost gas producer, it's not the end of the world. I also think, one point I would say here is, if you're patient, I don't think the downside here is that it's going to go to zero, right? Because I do have the upstream operations and even all the value in the driftwood site and the construction progress so far. I think there's some recoverable value out of that. So that's kind of my view on it. I think the risk reward is asymmetric to the upside, but that's not to say that it's actually going to happen, right? You certainly could realize the downside of that case, but again, I think the loss is not 100% there. So Vladimir says the CEO doesn't keep his promises and he has no credibility, or has no credibility. One day there will be a pump, I am sure. I don't trade it anymore, but may when it wakes up again. I've watched you and you're quite good. Oh, well, thank you. And I generally do agree, right? I think just talking on that real quick, that is one of the issues with Tellurian right now. Sharif Suki is the face of Tellurian, and he does the YouTube videos, and even before that, he's been fairly outspoken. For many years, and I think they've missed, you know, they've missed bunches and bunches of deadlines, and even some of the things like you're saying, uh, even more than missing deadlines, some of the comments around, hey, this is the easiest thing I've ever done for getting financing, that turned out to be, let's say reality didn't pan out. That stung a little bit or a lot. And I think that lost a fair bit of credibility. Some of the other comments like, Gunvor isn't going anywhere. They canceled that sales agreement. So, it's definitely an issue. Um, I think in the end, we'll judge them on the execution. I do think they've missed a lot, and so I would agree with you. Given the evidence right now, credibility is fairly low. But I'm still invested because I also do believe, the the fundamentals of it, right? That I think where they are positioned, in the LNG market overall is still, still has potential. Again, um, asymmetric upside, downside is kind of what I'm saying. Let's see, Vladimir says your financial analysis is definitely not a piece of crap. Oh yeah, sure. I understood what you were saying. And I've watched a couple of your videos, and sorry, my thing's overlapping. You are a credit to tell investors. Well, thank you very much. I really appreciate that. So I'm going to go ahead and go through, continue going through some of the assumptions I have, and then go through sort of the DCF model. And hopefully I'll reiterate one more time before I move on, just to say, this is just a model. This is a model of what could happen if things, let's say, go well. This isn't, a pie in the sky thing. I think these are realistic numbers, but these are all realistic numbers, assuming that they're able to line up all the sales, assuming that they don't dilute like horribly. And I have an assumption there on how much they do dilute, but I think that's that does remain to be seen, right? Even a lot of the projections, even just, I think it was today, there was the video where they're talking about future cash flows for the company, and they're talking, $1.3 billion, $1.7 billion in, 2029 or something. But that is a very fair point that the missing piece of information wasn't, the missing piece of information was how many shares do they think they're going to have outstanding in 2029, right? Because if they think they're going to get this done and they're going to have, 800 million shares, that's a drastically different than if they're going to have 1.6 billion shares or even more. They have enough control, I think, right now to basically more than likely to extend the authorized shares even further past what they have right now. So, that's a valid criticism, I think, right? In the uncertainty, that would be nice to really have some clarity from the company. Anyways, so I am going back to this. I'm using most of these particulars that they have here and some of the recent things that have been said. So I'm assuming, they, phase one, they maybe have equity partners, but they are selling up to, I think they've recently said 9 million tons, or 9 MTPA per year at Henry Hub linked contracts, and then the remaining 2 they're going to try to sell from the phase 1 volumes at the international prices, and then as part of phase 2 that they're going to additionally sell 2 MTPA from phase 2 at Henry Hub link prices, and then the remainder at international prices, JKM or TTF. And if I'm going to go through this just real quick, if you haven't dug in yourself, they sort of structure this in a way to say, hey, all of the sales and purchase agreements to Driftwood will be done sort of at this particular pricing, for the equity partners and or for just the volumes that they contract. And then if you are an equity partner, right, that you're going to get a dividend from that is going to help lower your cost basis to roughly break even, right? And they've talked about this where they say, you got to source the gas, and then you've got the operations that comes in at somewhere around, I think, $1.10 or so. And then they say, well, there's the debt service that costs about $1.10 as well. $1.15, I think, is what I use in my model. And so, after this, if you receive that dividend and then you're paying effectively, your effective price is this, your realized price over here, and that's what equity partners would get. That's how they're effectively getting the gas at cost. So that is kind of, those are the base assumptions I'm using in my DCF model. I'll pause here real quick because I see there's a couple more comments from Vladimir. Out of curiosity, do you recommend other stocks? For example, my biggest holding is Cardinal Health. I don't know enough about Cardinal Health. I mean, I've looked at it only in passing, and I don't have any particular opinion. And in general, I think it's good. Um, over 200 billion of revenue, valued at a little over 20 billion, pays a dividend as a path to growing their colossal earnings revenue. I'd love your take on companies like that. I will note it down. I will do some research. I can do a future video on Cardinal Health. Um, yeah. How many companies are valued at 0.1x of their revenue? Price of sales of 0.1. Yeah, that's interesting. Usually, obviously, it matters how much what their margins are, right? That's the big question, and what their future growth is. It's also sometimes a lot of times when I see companies that have very very low price to sales, either their margins are really low or they have a lot of debt, right? Where their enterprise value could actually be pretty reasonable, in terms of enterprise value to sales, but actually they have a lot of debt. And again, I haven't looked at Cardinal Health. I don't know. I will note that down. I will do a future video and sort of give some of my opinions on Cardinal Health. So I'm going to continue on with Tellurian here for today. So now if we get in my actual DCF model, here are the assumptions that I'm generally making. And again, this is even more simplified than some of the other ones that I've done in the past. It might look more complex. It's actually not. This is just sort of breaks things out over a bigger period here. So top left here, I'm going to look at my general assumptions. Let's forget about the rest of it for a moment. I'm looking at average Henry Hub price of about $4. A rough JKM, and you could substitute in TTF. I just wrote it down JKM, just to simplify the what the text that I had to write here on the model. Assume that's at $11. The liquefaction costs at Driftwood, sum up to about $1.10 per MMBTU, and then the debt service is about $1.15 per MMBTU in Driftwood phase 1. I assume, and this is the recent announcement or revelation announcement, whatever you want to call it, where Sharif Suki has said, hey, we're going to start actually looking to sell at Henry Hub linked contracts again. They've been trying to not do that for a while. But I assume that they can get that at Henry Hub plus 115, times 115% plus 275. That's the fee that they've talked about. They think that's, in the ballpark of what they can get and what's actually, whether it's financeable and profitable. And then the dividend for the equity partners in phase 1 would come out to about 50 cents per MMBTU in phase 1. And then I also modeled out, so this model, I should say, models phase 1 and phase 2. If you want to include phase 3 and phase 4, I did not include those here. Those are just given no consideration. Also, those would be additional upside to what this model comes up with in terms of a number. So for Driftwood phase 2, I assume that their debt cost is going to be, a bit lower because, it just doesn't cost so much for phase 2 per MMBTU. And, it comes out to more like 80 cents per MMBTU. I did a little bit of math to get to that number, but, right now let's just take that as a fact. And so here's my rough model. This goes by year and it starts in 2026, right? I'm sort of assuming that this is a model that assumes phase 1 gets its FID fairly soon, and that it happens here, and that the operations start in earnest in 2028. And in 2028 is when they actually start bringing in cash flows. And so I assume they have Tellurian itself owns or has rights to 3 MTPA at Henry Hub link prices, and then 2 MTPA that they're going to sell at international prices at JKM. And so in total, I assume they're per MTPA that they're going to get $25 million per Henry Hub linked volume, and for JKM it would be more like 238 per MTPA. And then you multiply that out, sum it up, and you get your phase 1 cash flows, where starting in 2028 you'd get about $550 million per year from the phase 1. Then you also have your upstream cash flows, which I included in here, and so this is assuming they ramp up to 400 million MMCF per day. Is that right? I think that's right. Maybe I have two millions in that number, but you know what I'm talking about. Up from roughly the 200 that they're going to be at the end of this year, I think, and so they ramp up to 400 there, and then again, they're selling that at Henry Hub, and I assume they're paying about $40 million in debt interest from the debt that they're probably going to incur to get to that point. They I think, I can't remember which video it was. We were talking about, hey, we're going to look at a financing facility to be able to ramp up the upstream production, and so that's my rough guess at how much debt service they're going to have at that point. One other thing I should mention is this model doesn't actually account for eventually paying off the debt. I just assume, hey, this is how much their interest is going to be on the debt, and they keep kicking the can down the road for this model. So, if you wanted to take that into account, that would be something else that you'd have to really think about. Now, I also assume that they, make their sales and that they start phase 2 construction in parallel with finishing up phase 1, and they start that in 2026, and that goes through 2029, and their actual costs they'd have to pay for this are going to be 1.6 billion. They're going to get debt financing for the rest, and that's where that 2.4 billion dollars of debt. This is me assuming the entire project is going to be about $4 billion. If you really want to pull on that thread a little bit, my basis for that, I look back at the original EPC contract with Bechtel for phase 2. I think that came up to something like $2.7 billion. I assume that added like another 20% just to get the updated EPC cost. Figure that's going to be, what does that come out to, $3.2 billion or something. I can't really do the math off the top of my head. And then I sort of added up some of the other costs I think you're going to have, which are less than you have for phase 1, but some of the other things that they are going to have to include in there, and say, great, let's just round it off and say it's about $4 billion. So those are my assumptions for, very, very briefly, for phase 2. And so their direct costs that don't come from the debt portion would be this 1.6 billion. And I actually assume that they're going to start, pay that initially while they are working on phase 2 in parallel with phase 1, where they're not yet having any cash flows from phase 1, just through dilution. You can see I have these assumptions over here. They're going to dilute 40 million and then 30 million at a share price of $4 per share of Tellurian. Maybe that's bearish. Maybe the share price will actually be much higher and this dilution will be lower. But I really did that to kind of do the math and say, hey, is this dilution meaningful? And 70 million shares, I don't want to say that's not meaningful, but I have a general assumption, I'll get to in a moment, that they're going to have over 1 billion shares by the end of, by 2030 or so, 2029, whatever time frame you really want to say, where they're getting this all done. And so 70 million shares is, I'm not going to say it's a rounding error, but it didn't materially change my rough estimate of how many shares they're going to have outstanding. So that is, what I did for how they actually get through the financing for phase 2. And then that sort of takes 4 years to build. And then that gets them to actually get some cash flows from phase 2. I assume those 2 million tons per year, the linked at Henry Hub, that they don't own, somebody else owns that. And and maybe if that ends up being the case as they suggested, maybe that would decrease their cost. Maybe there would be someone else who's got that. But for now, let's just assume that they don't really, that they have to front all these costs, and that they don't have any benefit from that. But that they do have this retained 3.5 MTPA from phase 2 that they can sell at international prices. And because it's a larger volume, they could sell international. That gets them again, slightly higher margins because there's lower debt on phase 2, and so that gets you to about $900 million per year of free cash flow. And so I think this actually lines up pretty well with the numbers that were in one of the most recent Suki videos. He didn't really break it all out, but it lines up. If I do the 892 plus the 550 for the cash flows from Driftwood LNG phase 1 and phase 2 that are actually attributable to Tellurian, this added up gets me to about $1.4 billion here. Starting in mine starts in 2030. I think he said 2029. Doesn't, it's important, but it can't really know up front. That's just a difference here. And so that's sort of where this comes out. You add in the profits that I'm assuming from the upstream gas, assuming that does become more profitable than it is today, gets about $300 million per year, actually 325 eventually. And add all those up and you're about 1.7, maybe 1.8 billion dollars per year in free cash flow once they've finished phase 2. And so what I then did, I have all this free cash flow every year Again, it's sort of, it's negative at the very beginning, where I assume, hey, they're just covering that with dilution. And so there's effectively zero net present value for that, because they're actually just making up the negative free cash flows with dilution. But then in a couple years, they have some free cash flow from both upstream operations and phase one, but that they are shoveling a fair bit of that money into phase two. And then starting in 2030, at least in my model, they have all the free cash flows from phase one, phase two, and their upstream production, and that gets you here at that $1.8 billion of free cash flow. So in every year, then I use a discount rate. I use a discount rate of 10%, and I discounted it back to 2023 to say, what is the net present value of those free cash flows in each year? Okay, and so if I look at that, and I go through, there's zero net present value for 2026 and 2027, because I'm assuming there's there aren't really any free cash flows. And then in 2028 and 2029, I assume that they have a bit of free cash flows, but that they are still, again, funneling money into building phase two, and so that's lower. And then starting in 2030, again, this is assuming they don't immediately turn around and put that money into phase three and phase four, which we know that they will, but this is just valuing phase one and phase two. So if they just do that, now they're actually raking in the cash, right? And this gets you to, in the first year of the full free cash flows, the net present value there is $900 million, because that's, it's what, 7 years away, and that's $1.7 billion at the moment. You discount that back at 10%, and that gets you to about $900 million in current value for their free cash flows in 2030. And then I extended this model using literally just the same numbers, going further and further out, just so I didn't have to deal with terminal values, and just to show you what this looks like, right? Over time, you really discount it back, and it's not worth that much once you go out far and far and far. I think I did this for, 40 years or 30 years. I guess 40 years of actual operations. At that point, we could just say the terminal value is zero. So, hey, this is all the cash flows that we're going to get. This is the current value. Add all of those up, and now you get to the sort of punchline here. But I wanted to walk you through everything to get to that point. That's my style. And so use a discount rate of 10%. That gets you this full net present value. Add all of those future cash flows up and discount them, and that gets you to about $10.3 billion in current value. Now, I then looked. I did a rough estimate of how many shares we think they're going to have outstanding in the future. About 1.3 billion shares. Just divide that out, and that gets you to a net present value per share at FID of just a tad under $8 per share. And again, this is given that expected level of dilution, right? Because this is dividing across 1.3 billion shares, not across the what is it, 600 million or 700 million they have outstanding roughly right now. And so that is the result of this. Now, as I said, this does not take into account, paying off the debt, which they will eventually have to do at some point, and you could subtract that off, in one way or another, however you decided to do that. And it also does not take into account any value for phase three and phase four, where presumably these cash flows will be enough for them to pay for phase three and phase four. They could probably start it just paying it 100% by themselves starting in 2030. Yeah. And so, Vladimir, sorry, I just saw that you said, I was wondering about dilution. Said you explained that well. Yeah. And so, look, this is a shot in the dark, right? I think they've upped the authorized shares to 1.6 billion. I think they're diluting, at least right now, to pay for things. There's a question of how much are they going to have to dilute right now? And there's also a question at what share price are they going to be doing all this dilution? Because if they need the cash before they can actually close on the financing for phase one, they're diluting at $1.20 per share, and probably actually realizing quite, slightly less because they pay fees and stuff on that. So, if they need to make up a couple $100 million, like that can be a couple $100 million shares real quick. It adds up. If they don't need all that money right now. And again, that's why I looked at it. Hey, if we're talking about dilution to fund some of phase two, because they want to start phase two before they've got all the cash flows from phase one, or they want to even do it faster than what they can do just from those cash flows, then, hopefully they're diluting at a higher share price, and so at that point it gets to be much less. And even if they wanted to start, let's see, phase three and phase four in parallel of phase two, if the share price is up at $10 per share, in the future, because which is very, very possible. I just came up with the model at $8, but the $8 isn't today, right? If we're looking at 2026, 2027, these free cash flows, or these cash flows from phase one to phase two are much closer. It's not 7 years away, it's 2 years away. And so the stock price, is very reasonable for that to think that it's going to be even higher. And so I think the dilution will go down over time. But again, this really all hinges on, can we get positive FID, for phase one? Can we actually make that all work? Because that takes out a lot of the risk, right? That at least says, you know what, even if we do nothing past phase one, at least we can point at and say, you can delete all this phase two stuff off of here. And, you know what, I could probably do that really quickly right here. If I just zeroed out all of these, make these all 0. And then if I just did, if I made all of these 0, I think that would do it real quick. And so you can look at real quick, the net present value, if we ignore phase two, is more like 480. But you start realizing that value sooner, right? The net present value of, you get, this has some free cash flow from the upstream operations that you even get starting in, in 2026 and 2027, because sort of the costs to construct phase one are not in this model at all, right? I've sort of assumed that's already been taken into account elsewhere. But if you look at that, then your free cash flow, you're starting to get $500 million of, sorry, 875,000, so almost $1 billion free cash flow just from that phase one in 2028, right? And so if you're just, if it's 2026 and I'm only a couple years away from almost $1 billion per year of free cash flow from this, from between phase one and the upstream operations, that discount is not that large. And so you're looking at, quite a bit there. And so again, if I went to phase one and I said, hey, what if they were able to do this? And because they didn't have to dilute some for phase two, this is more like, let's say 1,100 or 1.1 billion shares outstanding. That's pushes up your stock price slightly higher because you have less dilution. But anyways, sorry, you didn't actually ask the question. I just decided to ramble there. So you said, Vladimir says, but my guess is that they will do more dilution as investors will want a bigger pie, a bigger piece of the company. I think you're saying if you increase the dilution and their operating costs are higher than your valuation, can drop below $3 per share very quickly. Yes. 100%. Right. So let's look at that. To some degree, they're, the debt is a very large portion, right? So if their liquefaction costs were actually, they project that it's going to be $1.10. Let's say they were off they underestimated by, I don't know, what's it be 30%, and say it's, 35%, it's more like $1.50 for the liquefaction costs. You can see real quick that turned their cash flows. I think this was $550, right? You look over here, this was $550, and when I make that change, it goes down to $450. And then what did you say? If there's more dilution, yeah. So let's say they hit their max of their current outstanding shares, right? They get the 1.6 billion shares. So that's what I think is a material increase in the liquefaction costs, and more shares outstanding. That gets you to sort of a net present value per share of, under $6. So not quite below 3, unless you really think, if you think this is going to be even higher, $2 for the liquefaction. There's still some margin to be had here, right? But and really a lot of this comes down to, I'm going to get to what is the biggest assumption here. So let's go back to that 150 for liquefaction costs. The biggest assumption here is the spread that they think they're going to be able to get from JKM to Henry Hub, right? Let's do one other thing here, right? If we say Henry Hub prices don't go to the moon, right? They stay at $4, but you look at JKM and you say, well, what if for whatever reason, let's say lots of Asian countries and European countries, solar just is a massive thing, right? They have a breakthrough in solar, and just the overall demand for LNG is lower, and so let's say instead of $11, this drops down to even $9, right? And now that cuts your profits for the JKM, pretty much in half. That real quickly, that one change. Sorry, let me undo that. So it was $11. That got me with some of these assumptions. This is a higher liquefaction cost and 1.6 billion shares outstanding. This had a share price of just under $6 in net present value. But if I change this again from $11 JKM to $9 JKM, that got me from being just under $6 to under $4. And that was a fairly small shift. Hypothetically, if it went even lower, if this went to $7, now your net present value is under $2. And I think there's valid reasons, and that's to some degree, right? They are taking on this commodity risk, right? They are taking an opinion on the spread. That is what they're basing their entire business off. That's what they think is going to be the lucrative part, is that there are going to be these persistent spreads between JKM and TTF, LNG prices and U.S. Henry Hub gas prices. And so if that assumption ends up being false, that is going to take away most of where they think they were going to get their money from. That cuts both ways though, right? Like at the same time where I can say, hey, if it's dropped from $11 to $7, for the JKM price, after transportation costs, this can also go the other way, right? That $11 could go up to, $15. And now all of a sudden it's actually much higher, right? Now instead of going from $6 to, $3 or $2 in net present value per share, you're looking at the opposite direction, where now it's actually more like $10. And in the future, that could be way high, right? Like when you're not discounting these cash flows 7 years, to today, and you're actually realizing those, we're looking at cash flows here where, we're like $2.7 billion per year. So that commodity risk goes both ways, right? It could go bad or it could go very well. Yeah, so that's sort of my comment on that. Vladimir says, great work. You are right when it comes to costs and future potential dilutions. I hope they can't take on more debt, as the cost of service that debt can reduce EPS. 100% agree. And Transient Stacker says, hello. Hey there, Transient Stacker. Sorry, I haven't done a whole lot of videos recently. Life has been busy. And I'm actually at the very end of this one. So I don't have anything more to say. I think I talked this model through pretty well. As I said, I'm going to, once I get right off here, I will edit the description. I will put a link to the spreadsheet and make sure it's shared out. So you all can take a look if you want. You can make your own copy and then edit these values to your heart's content, and see, sort of check your own assumptions, see what that does to the value. So, all right, I am actually going to hop off. I'm going to try to do more videos. I know it's been a couple months. I've been just busy. I'm going to try to get back into it, do at least one a week or so. It's pretty that's the cadence I'd like to at least get to, maybe even 2 a week if life allows it. So Transient Stacker says, missed the notification. Yeah. Sorry, I don't know how YouTube actually does things. It's kind of a crapshoot, I think. Like I said, that both as a person who's making the videos and person who's subscribed to other channels and stuff, it doesn't seem consistent. I'm not really sure. So, all right, I'm gonna hop off now. I really appreciate the back and forth, Vladimir. Vladimir says, thank you and good night. I randomly was online when you did a video. I'm glad to have you. I'm going to try to do more. I almost always do these as, live streams, just because it's, it's not quite as polished as doing sort of an edited video, but, it takes less time and does have some back and forth. Like, I think it's actually very, very useful and helpful to do, to have some real-time feedback on these things. So Vladimir says, I usually see these videos well after you live stream them. Yeah. Like I say, I am going to try to do more. So, and Transient Stacker says, I'll rewatch it. Okay, so I'm going to hop off then. Thank you both for being here. And anyone else who's watching After Fact, have a good one. Really appreciate it. Take care.